My grandfather was a careful man. He kept money in the bank his entire life, never touched it unless he had to. Every month, a little more went in. He thought that was the responsible thing. He told my father the same thing. And my father told me, the bank keeps your money safe. That is what banks are for. He was not wrong, technically, but there was something nobody told him. Something that was not illegal. Something that was not hidden. Something that was written clearly in documents he signed. He just never knew what it meant. By the time he retired, his savings had grown. The number on the paper was bigger than when he started, but what it could actually buy had quietly, steadily shrunk. Nobody stole from him, and yet something was taken. Here is how a savings account works. You deposit your money, the bank holds it. You receive interest. The bank promises to return your money whenever you ask. That is the deal on the surface. Here is the deal underneath. The bank takes your money. It lends it out immediately to other people at a rate several times higher than what it pays you. The difference between what they pay you and what they charge others is called the spread. In 2021 and 2022, the average savings account in America paid depositors 0.06% interest. The average car loan that same year carried an interest rate of around 5 to 6%. The average personal loan was 9 to 11%. Credit cards were between 16 and 24%. The bank borrowed your money for almost nothing and lent it out for a significant return. That part is legal. That part is expected. That part is how banking works. You probably already knew that, even if you never said it out loud. But that is not the scam. The scam is quieter than that. In 2022, inflation in the United States hit 9.1%. In the United Kingdom, it reached 11%. Most of Europe was somewhere between 8 and 12%. During that same period, most savings accounts in those countries were paying between 0.1 and 1%. This means that if you had $100,000 or pounds or euros sitting in a savings account, the number in your account may have gone up. You may have earned some interest. Your balance on paper looked stable or slightly larger, but what that money could actually purchase had decreased, in some countries by a third, in some by more. You did not lose money in the way a robbery works. Nothing was taken from your account. The transaction log was clean, your bank was operating lawfully, and your savings were quietly worth less than they were 12 months earlier. This is called a negative real interest rate. Your interest is lower than inflation. The result is a slow, invisible drain. The bank does not call it a scam. They call it market conditions. After World War II, the United States government was carrying an enormous debt. The war had been expensive. Paying it off directly would have required decades of painful austerity. So governments across the Western world did something else. They kept interest rates artificially low. They kept savings accounts paying almost nothing. And they allowed inflation to run slightly above those rates year after year for almost 2 decades. By the time it was over, the debt burden had been significantly reduced. Not through payment. Through inflation eating away at the real value of what was owed. Economists have a name for this: financial repression. It means a government, working alongside its banking system, maintains conditions where the returns available to ordinary savers are systematically lower than inflation. Wealth is quietly transferred from the population, which holds savings, to the institutions and governments that carry debt. No guns, no announcement, just policy. This is documented history. Carmen Reinhart, one of the most cited economists alive, published research specifically on this mechanism, how it was used after World War II, and how it reliably appears when governments carry high debt. Now look at where we are today. Government debt in most major economies is at or near post-war highs. The interest rates that central banks control have moved significantly in the past 2 years. But those increases reached savings accounts much more slowly than they reached mortgage rates, loan rates, and the returns that banks charge for lending. The spread has actually widened in some countries, not narrowed. And inflation, even as it moderates, is still running above what many savings products return in real terms. Meanwhile, a large portion of the population keeps the majority of their financial savings in standard bank accounts. Not because they are foolish, because they were told that is where money goes. They were told it is safe. The number does not go down. So it does not feel like a problem. That is exactly the mechanism. The loss is invisible because the number stays stable or grows slightly. But purchasing power does not show up in your account balance. There is a reason this continues generation after generation, even when economists explain it in public. The loss is slow. It does not arrive at once. There is no moment of crisis, no notification, no statement showing you a negative sign. You do not feel poorer on any specific Tuesday. The erosion happens across years. And human psychology is built to respond to immediate danger, not slow drift. The second reason is that the alternatives feel complicated. Most people have heard words like treasury bills, money market funds, index funds, and I-bonds. Most people do not know the difference. And when you do not understand something, the safest instinct is to stay where you are. The third reason is trust. The bank has always been there. Your parents used it. It looks stable. Moving money feels like a risk, even when staying is the actual risk. This is the uncomfortable truth. The system does not need to deceive you actively. It only needs you to stay comfortable and uninformed long enough for the math to do its work. Nobody is going to call you. No alert is going to tell you that your savings lost value this year. The bank's job is to hold your money, not to optimize it for you. That distinction matters. Your grandfather's mistake was not trusting banks. Banks serve a function. The mistake was assuming that keeping money in a savings account was the same as protecting it. It is not. It is only protecting the number. The number is not the money. What the money can buy is the money. This is not a new problem. It is a structural feature of how modern banking and monetary policy work. And it has been used deliberately in the past by governments carrying debt. The governments of today are carrying more debt than almost any point in recorded history. That context is not coincidence. It is data. The point is not panic. Panic is what keeps people paralyzed and moving into worse decisions. The point is positioning, understanding where money actually holds value versus where it just holds a number. Here is where money tends to move when real interest rates go negative. The first is into assets that produce something. Property that generates rent. Businesses with actual cash flow. Equities in companies that hold real assets or have pricing power, meaning they can raise prices when inflation rises and not lose customers. During the 1970s inflationary period in the United States, commodity companies and real estate held value while cash-heavy savers lost purchasing power consistently. The second is into instruments that track inflation directly. In the United States, I-bonds issued by the government are tied to inflation rates. Treasury inflation-protected securities, called TIPS, work on a similar mechanism. These are not investments in the traditional sense. They are simply places designed to not lose to inflation. Most people have never bought one. The third is into high-yield savings accounts or money market funds. Not all savings accounts are equal. Some online banks and money market funds in 2024 and 2025 have been offering 4 to 5% annual returns, significantly above the rates at traditional retail banks. Moving from a 0.5% savings account to a 4.5% account on the same amount of money, with no additional risk and full liquidity, is the simplest adjustment most people never make because they do not know the gap exists. The fourth is shortening the duration of anything fixed. If you are holding long-term bonds or long-term fixed deposits and rates are rising or inflation is high, you are locked into a rate that will lose real value over time. Short-duration instruments let you roll into better rates faster. The common mistake is waiting. People research all of this, understand it, and then keep the money where it is because moving feels inconvenient. That hesitation is the mechanism that the system depends on. You do not have to move everything, but knowing that nothing, by default, is protecting you, and that you have to make an active choice to protect yourself, is the shift. That is the awareness. My grandfather was not uninformed. He was working with what he had been given. The information you now have, he did not. The question is what you do with it.